Good day everyone, welcome to the 10th tutorial session, and today we're gonna cover two chapters. The first one is the 15th chapter about raising capital, and the second one is 17th chapter about dividends and payout policy. So I'm gonna give you an overview about the 15th chapter about raising capital. So there are basically there are two types of raising capital. The first one is to issue a debt, and the second one is to issue shares or stocks, or call it as equity financing. There are various methods in issuing new securities. The first one is to traditional negotiated cash offer, which the company will negotiate this one. From commitment, there are three types of the traditional negotiated cash offer. The first one is the firm commitment cash offer, which the company negotiates an agreement with an investment banker to underwrite to distribute the new shares, and a specified number of shares are bought by underwriters and sold at a higher price. The second one is best efforts. Best efforts have the definition as the company has investment bankers sell as many of the new shares as possible at the agreed upon price. So there are no guarantees concerning how much cash will be raised. So that's why they name it as best efforts, because best effort means so there are no guarantee for the firm to receive a specific amount of cash. And the third one is Dutch auction cash offer. So the definition of these is the company has investment bankers who will auction shares to determine the highest offer price obtainable for a given number of shares to be sold. So you may notice there are new terms for you to acknowledge. The term is underwriters. Underwrite. What is underwrite? So basically, underwriters are investment firms that act as intermediaries between a company selling securities and the investing public. So let's take an example for maybe you have a company name, maybe company X. The X company, or let's say Tesla. Maybe Tesla want to issue securities. They want to issue shares. They want to go into securities financing. They need to have underwriters. So let's say that Tesla needs 2 trillion rupiahs. So they contact the investment bankers, investment firms called as underwriters, to value to get 2 trillion rupiahs, how much shares they have to sell. So they value their stocks. They do the company valuations, the stock valuation. You maybe have heard some of these stock valuation. So they value each of these firm stocks, and then they decide how many stocks that it needs to be sold to the public. So that is so the firms will get 2 trillion rupiah. So the firms get 2 trillion rupiah from the investment firms. Let's say JP Morgan. Let's say JP Morgan buy 2 trillion rupiahs of the Tesla shares. So Tesla get the 2 trillion. So, but JP Morgan then acquired the ownership of the, let's say the 4 million shares of Tesla. So there are 4 million shares of Tesla owned by JP Morgan and ready to be sold to the public, So we as a secondary in the secondary market, as the public, will buy the shares from the investment firms. So JP Morgan will sell them to the so-called securities. Maybe you have heard of MNC Securitas, Mirai Asset, or something like that. And they sell the shares to the security house, and then the security house will sell them to us as the public. So you can buy the Tesla shares from the app such as StockBit or other, Indo Premier or something like that. So you could buy the stocks of Tesla. You could gain ownership through the secondary market. So underwriters such as JP Morgan Chase, as I have mentioned, it operates in the primary markets. So if you buy the shares of Tesla, maybe stock price going up, you buy shares of 50,000 rupiah each. The 50,000 rupiah won't go into Tesla. It will go into the security house. They will gain the 50,000 rupiah, but Tesla won't gain anything. So that's how underwriters work. So this is an important discussion because it's really important to know to differ primary markets and secondary markets, and where does these underwriters operates. They only operate on the primary market. They don't really operate on the secondary market. So that's the first method there. It took a long while to explain the first method. Let's get on to the second method. It is privileged subscription. So privileged subscription has two types of offers. The first one is direct rights, which the company offers the new stock directly to its existing shareholders. So it's not if Bank Mandiri or Bank BNI or Bank BRI wants to offer the new stock, rights offer is only available for companies that already publicly listed, such as Bank Mandiri, Bank BNI, or Bank BRI. If they want to raise new shares, want to raise money using security financing, they could have an option such as a direct rights offer. So they offer their stocks to their existing shareholders. And the second one is the standby rights offer, which is primarily looks like the direct rights, but contains a privileged subscription arrangement with existing shareholders. So the net proceeds are guaranteed by the underwriters. So there are privileged subscription arrangement with existing shareholders. So it's a bit, there's a guarantee. There's how to differ the standby and direct. And the third one is non-traditional cash. There are two types: shelf cash offer and competitive firm. The first one is qualifying companies can authorize all shares they expect to sell over a 2-year period and sell them when needed. And the second one is which the company can elect to award the underwriting contract through a public auction instead of negotiation. So it went into auction. There are three methods of public offerings, as you can see, but in terms of private offerings, there are there's only one type that is called as direct placement, which the securities that sold directly to the purchaser. So this is the going over negotiation, such as over-the-counter negotiation. So that's how to differ. Public placement that have three methods. You don't have to memorize all the types, but there are three methods of public offering, and there are only one method for private offering. And that's how underwriters work only on primary markets. And then there is I have explained this earlier, which from commitment, the type of commitment in which the underwriter applies the entire issue, assuming full financial responsibility. Full financial. So this is the keywords right there. From commitment is full financial responsibility. Best efforts don't have without financial responsibility, and Dutch auction is the underwriting, which offer price is set based on competitive bidding or uniform price auction. So this is the keywords right there. And there are another type, which is the venture capital. Venture capital is financing for new, often high risk ventures. So venture capital operates in how they operate is that they invest some amount of money into the firms, and then they gain a percentage of ownership of the firm, and they at the end of the period of the negotiated period, there are only two exit strategies for the firms. The first one is to sell the firms to the venture capital, and the second one is to go into initial public offering. So there are only two exit strategies at the end of the venturing. Let's say I a bit forgot about the terms, but let's say the venturing period maybe lasted 5 years. So at the end of year 5, the firm need to choose whether it's going to sell the firms into the venture capital, or is it going to undergo the process of the initial public offering. So that's a brief explanation about chapter 15. Exactly, there are only brief overview, and I'm going to explain a bit about chapter 17, which is covered the topics of dividends and payout policy. So what is dividend? Dividend basically is a payment made out of the firm's earnings to its owners, either in the form of cash or stock. And there are two types of dividend. The first one is cash dividend, which is a cash payment, and there are stock repurchase or stock dividend, the purchase or stock dividend. Sorry. So the stock, and there are the other types of those is stock repurchase. So this is not a dividend. This is a process of the purchase by a corporation of its own shares of stock, known as a buyback. So there are two types of dividend. The first one is cash dividend, and the second type is stock dividend, which that allows you to gain a lot more ownership of the firm by stock, by owning some more stocks. This is the explanation of stock dividend: payment made by a firm to its owners in the form of stocks, diluting the value of each share outstanding. So this is there are another process between the stock dividend, stock repurchase, and the other process is stock split, which is the increase of a firm's shares outstanding without any change in owner's equity. So there are I explained the terms briefly, and we're going to see how it affected the financial condition of the firm. But we're going to discuss a bit about the pros and cons of paying dividends. So the pro is that cash dividends can underscore good results and provide support to the stock price. Investors will be more likely to buy a stock with a regular cash dividend. Second one is dividend may attract institutional investors, such as institutional investors. Let's say that banks or investment bankers, which will bring a huge amount of money into the firm. The third one is stock price usually increase with the announcement of a new or increased dividend. So this is why, because this is just it's definitely just because the people will buy more stocks, so the price will increase, and the dividends will absorb excess cash flow and may reduce agency costs that arise from conflicts with the management. So this is more comprehensive, more detailed explanation about agency costs, so I won't go really deep into this. But the cons is dividends are taxed to its recipient. So if let's say that I own stocks of Bank Mandiri, and Bank Mandiri will give me dividends. So the dividend given by Bank Mandiri are subjected to tax before I could gain the dividend. I forgot it's how about the percentage, but dividends are subject to tax. The second one, dividends can reduce internal sources of financing. So if you still remember, the net income of the company goes into two ways. The first one is dividend, to be paid as dividend, and the second one is to be retained as retained earnings, or the internal source of financing for the next year. So that's the cons of dividend. And the third one, once established, dividend cuts are hard to make because it's going to be affecting the stock price. It's going to be affecting the stock price because the investor will, they will see the firm, they will perceive the firm as less profitable than before. So this is a negative sentiment for the stock price, and will be more likely to sell the stock, and affecting lower stock prices. So that's an overview for the two chapters, and we're going to cover the problems, sample problems in the next session.